We have an agreement with the Iranians that they're going to open the Straits of Hormuz and that we'll have a ceasefire. And they have said that they're going to start letting many more ships through, being mindful of the fact that if you get one of those big tankers through, that's 2 million barrels. And we've got the A team of people going there, and hopefully JD as well. And we fully expect that we've got so much on the table that we're willing to give to help the Iranian people if they just act normally, that hopefully there'll be cooler heads and sounder minds at the Iranian side, and that we'll come to a final agreement this weekend.
That was White House National Economic Council Director Kevin Hassett with Maria yesterday saying that he hopes a final deal with Iran will come this weekend. Now, taking a look at futures right now, as you can see, we are now sliding into the red just slightly. Dow down 75, S&P down 4.5, NASDAQ down 5 3/4. All three major indices, though, did gain yesterday. We started the day negative yesterday, and then we closed higher on the session. The S&P 500 up for the 7th consecutive session, actually. Now, oil prices this morning, we are still below $100 a barrel. 12 tankers have reportedly crossed the Strait of Hormuz since the 2-week ceasefire began Wednesday. Only one was flagged as non-Iranian. Now, President Trump posted to Truth Social last night, quote, Iran is doing a very poor job, dishonorable, some would say, of allowing oil to go through the Strait. That is not the agreement we have. I want to bring in Harris Financial Group Managing Partner Jamie Cox. Jamie, your reaction to what you're seeing in the markets, a market reaction to this?
Well, I think markets are holding up remarkably well, given the difficulties. I mean, when you see supply shocks and things like energy, these things tend to topple over markets and produce much larger losses than we've seen here in the United States. And I think that is a good thing. I think I think market participants sort of see this as a short-term thing and are trying to look through it. And I think that's why we've seen such stability in our markets, because anytime you see any type of deal being made or the prospects of something ending the conflict, you see markets resume and reverse higher. And if that trend continues, I think you can sort of say that markets believe that we're out of this conflict, more quickly than people might think we will. So I think what really matters, though, Cheryl, is what the impact to inflation is and what the impact to the consumer and impact on the economy is going to be. Because if this conflict goes longer than what markets expect, I think you're going to see the reverse happen, where the reality check will be inflation is going to bite consumers, slow the economy, and that's not going to be a good thing for anyone. It's not going to be a good thing for consumers. It's not going to be a good thing for midterm elections. And I think that's the tug of war that we're in right now. But so far, markets have been really, really stable.
Well, actually,
and that's helpful for us.
But Maria asked Kevin Hassett about the economy yesterday. Listen to what he told her about growth.
President Trump not only will resolve this in the short term, but in the long term, his policies are going to create a golden age. And so I began the year with a guess that we'd probably be in the 4 to 5 range for economic growth because of all this. And I'll stick by those numbers. I think this is a temporary a distraction that will very, very quickly go away.
So you still look for 4 to 5% growth for this year?
Yes, that's right. That's right. Because productivity is already giving us 2.5, and so if we get a little out of everything else, then you can get way north of 3.
He's sticking by that 4 to 5%, Jamie. Jamie?
Sorry,
okay.
I'm sorry.
Let me bring in John Lonsky really quick. We'll work on Jamie's shot. John Lonsky, again, she redirected. She said, you're sticking by 4 to 5% growth, and he said yes, absolutely. That's in the middle of week 6 of this conflict. So
I don't think it's going to happen. Okay, even before the conflict, the consensus forecast had real GDP growing by something closer to 2% as opposed to 4 to 5%. And we're looking now at what's likely to occur with first quarter real GDP growth. GDP now came out with an estimate yesterday. 1.3% growth quarter to quarter annualized growth rate. Maybe real GDP growth in the first quarter could be as high as 2%, but 4 to 5%. Dream on.
Okay, all right. Well, I mean, that's Jamie. I understand you're back with us. Your reaction to what you heard from Kevin Hassett yesterday, what he told Maria.
I think that's a moonshot. I do believe that GDP will definitely be positive, but 4% is really difficult to get, especially in the context of this conflict. I mean, there's going to be lots of things that will the consumer remains strong. There's plenty of reasons why we're not going into recession, but to have 4% growth would require a very, very big change in the economic outlook, and I don't think that's going to happen. I think the base case is that inflation may dent consumer spending more than people anticipate at this point.
Real quick, I do want to pull up yields with you, because right now futures traders are pricing in about a 30% chance for a rate cut in the second half of the year. These dynamics have changed, and Fed officials did raise their 2026 inflation outlook in March due to war-related oil shocks. We're going to get CPI for March at 8:30, so that's going to show us what we expect, which is going to be a rough energy story. But there's multiple reports out there that Kevin Warsh's nomination hearing for Fed chair may be delayed at least a week. The panel's collecting his paperwork, including financial disclosures. He's also expected to meet with Senator Tom Tillis on Tuesday. That's, what we've heard from Tillis. He's not doing anything until the Jerome Powell investigation is over. So we'll see how this all goes. Kevin Hassett told Maria, he, by the way, does not see Jerome Powell staying on the board. He thinks that he will be exiting the stage in May. Jamie, your reaction?
So I think the two things that are most important is the Fed, the dual mandate Federal Reserve in the United States is not going to raise interest rates in a supply shock. And that should bring comfort to a lot of people. That does not mean that they're going to lower rates. I think that would be difficult to justify at this point. But here's the main thing. In the U.S., we're going to have stable rates. In Europe and other places where they do not have a dual mandate central bank, they're probably going to have interest rates that are going to rise. And I think that's going to provide us some differentials there that will help. Okay. And it will sort of, not necessarily require us to lower rates. So I'm actually happy to have a dual mandate Fed for once, because, if we were to raise interest rates into a supply shock, we would definitely precipitate potentially a recession and make money tight at a time when it would be not a good idea to do so. But I think the prospects of lowering rates, things are going to have to change dramatically, and the war and the conflict are going to have to end pretty quick to justify that, even towards the end of the year.
Well, again, I think that the markets are going to be watching all of the developments this weekend. And of course, Maria is going to be speaking with the president on Sunday. So, we'll see how this all plays out. Jamie Cox, great to see you. Thank you for being here.
Thank you.
All right, we'll be right back, everybody.